AI trade tops geopolitics, Indian autos binge on Festive cheer, and my take on Goldman Sachs. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. So the week of reckoning has come and gone for Wall Street. Everybody was excited. All investors were like, it was nervous, jittery. A lot of developments were happening last week. So yeah, it's just come and gone. And despite some hiccups, at the end of the day, all those nerves, all the jitteriness and all the nervousness was all for nothing because markets kept going higher, closing out October with a 3-week win streak and a 6-month positive streak. It's almost as if week of reckoning, call it whatever you want. Nobody cares. There's only one way up. There's only one way, and that's up, which is kind of worrying on its own. Anyway, more on that later. Oh, and also, by the way, just so before we go into each of these segments, just so you know, we also got the first $5 trillion market cap company as well. More on that in a bit. Once the dust had settled, all three indices firmly ended in the green. The Dow up 0.8%, S&P 500 up 0.7%, and the tech-heavy Nasdaq surging 2.2%, thanks to some stellar earnings from a few of the Mag 7. Not all, but a few. And I'm going to dig into each one of them in our first segment, Doctor's Weekly Snapshot. So I'm not going to waste any time. Let me welcome you straight to the first segment, Doctor's Weekly Snapshot, and take you through the key developments of last week. And boy, there were many. There were three major developments. If I were to take little, so when I say many, there were many small developments here and there. But if you were to classify the developments into themes, there were three major themes last week. The Fed, President Trump, President Xi showdown in South Korea, and of course, 5 of the Mag 7 reporting their latest quarterly numbers. So let's go through them one by one. And I'm going to start with the most critical market driver, the one that ensured that markets would end October on a high, despite all the nerves and all the buildup that we had going into the week. Most critical market driver earnings were from 5 of the Mag 7, and that's Alphabet, Microsoft, Meta, Apple, and Amazon. And the good news is all of them reported very strong earnings, in my opinion. Yes, Meta, Facebook parent Meta, missed the EPS beat, but that was due to a one-time income tax expense. So if you adjust for that, then the social media also posted some positive EPS growth and some very strong EPS growth, actually. Amazon and Alphabet were the standout performers, with the former hitting an all-time high after reporting significant growth in AI-driven revenue and announcing some major expansions in data center capacity. The one recurring theme from the earnings report, and this particular theme might be very common to, very, very familiar to all of you, since this is all what we have been talking about through 2025. If you take all the episodes I've covered, if you look at any financial news outlet, if you look at any interview from hedge fund managers and other asset managers, then the one recurring theme, it's a very familiar, it's an all too familiar theme, and that is that AI-related CapEx spend is not ending anytime soon. Every single executive from 5 of these Mag 7 that reported the earnings, who went through, if you listen to each of their earnings call, it's very clear, AI-related CapEx spend not ending anytime soon. But, let's forget about this. Let's end this debate once and for all. Will they spend? Won't they spend? They will continue to spend, at least well into 2026. In fact, the common buzzword among all 4 tech giants, Microsoft, Meta, Amazon, Google, is that apparently all 4 of them at the same time are capacity constrained. Now, the cloud hyperscalers, Microsoft, Amazon, Google, also mentioned that they see demand outstripping supply, and so they have to keep building for the foreseeable future. As things stand, foreseeable future will end in 2026. Something tells me 2026, they're going to say foreseeable future will then extend to 2027. So that seems to be the theme. Back in 24, they said 25 is going to be spending year. 25, we are now into 26. Based on what I'm seeing, based on what I'm observing, based on the tone from the management, I would be betting my money on 27 being a spending year as well. All 4 tech giants plan to invest $400 billion in AI initiatives this year, but all of them at the same time, 400 billion spending, they've all announced together, but all of them at the same time say that this spending remains insufficient given the surging demand and compute limitations. Furthermore, during their earnings call, all four firms, like I said before, indicate that investments in 2026 will be higher than first what they initially projected, and it will definitely be higher than what we saw in 2025. Now, the intriguing part is that investors reacted differently to the same news from the four giants, perhaps mentioning that perhaps there is some AI sanity after all, like WSJ Wall Street Journal columnist James McIntosh on his Streetwise column indicated perhaps there is some AI sanity after all. For instance, Meta actually dropped 12%, shed $215 billion in market value in one day. I'm a Meta investor, hurts, but probably I see it as a buying opportunity anyway. More on that in a bit. Anyway, Meta dropped 12%, Microsoft dropped about 5% post their earnings release, whereas Amazon surged nearly 10% and Alphabet had some strong gains too. Now, to me, the post-earnings sell-off in Meta, like I said, disclaimer, I am a shareholder in the name, is clearly overdone. Having said that, in my view, the move has more to do with investor psychology than actual company fundamentals. 3 years back, Meta shares sold 70% after the company announced that they're going to spend billions and billions and billions on the metaverse. They even rebranded the name to Meta from Facebook. Remember the time it used to be called Facebook, ticker symbol FB? Yeah, 3 years ago, they rebranded it to Meta with the ticker symbol of, Meta. They called the company Metaverse, and now it's called. Then they switched it to Meta Platforms because I think Metaverse was trademark. They couldn't trademark Metaverse, and it changed the name to Meta Platforms and the ticker symbol Meta. So and they said and Mark Zuckerberg at the time said, I'm going to spend billions and billions and billions on Metaverse. Now, Meta's Reality Labs, which houses their whole metaverse ambitions, has been losing money quarter after quarter, albeit they are on track to turn things around, in my view, courtesy of the Meta Ray-Ban glasses. So it's only natural for investors to have what I call PMSD, which is post-metaverse stress disorder, when the company announced in the most recent earnings call that their capex for 2026 will be notably larger than previously expected. In other words, when there is uncertainty surrounding the spending number, you can call notably. What is notably? Okay, you can't really put a number, right? So notably larger. And when investors, so when there is uncertainty surrounding the number, and when investors have gone through a similar experience in the past, it can only mean one thing, that there would be a sell-off. Okay, at least we didn't get a 25 or 30% sell-off post the earnings numbers 3 years back. It was half of that, but the sell-off makes sense because this is all about investor psychology, except for the fact, okay, I can defend the sell-off only to that extent. I can only say that, investor psychology, except for the fact that this time things are not the same. Yes, you will say, oh, this time it's different is probably the biggest pitfall any investor can get into. Completely agree with that argument. But let's dig a little bit deeper. The difference between 2022 and 2025 is that AI is real, and Meta is already an AI winner, with the technology delivering growth for its ads business and also increasing the interactions and engagements in the company's family of apps. In other words, the investments are translating into actual revenue growth and actual EPS growth. Yes, they missed the tax expense, but they've clearly mentioned that if it weren't for the tax expense, EPS would have been $7.25, which would have smashed analyst estimates, $7.25, which would have absolutely smashed the analyst estimates. And they actually also said that going forward, their tax expenses are going to be much lower now that they've gotten rid of this one-time tax expense. So I don't see a problem behind Meta spending in 2025 and 2026 compared to where I really had a problem back in 2022 when they were just throwing money at Metaverse, which was not something substantial, which had not, nobody knew where it was heading. Whereas we know for now, based on the evidence that we have, that AI is actually heading in the right direction. Moreover, they haven't even sorted out the budget yet, which means the final numbers could definitely change, although it's most likely to be higher than 2025. One very common theme is that it is more likely to be higher than in 2025. Finally, the budget is not set in stone, and Meta, unlike in 2022, is actually in a position to adjust their budgets in however they see it fit, however management sees it fit. All in all, I think the reaction to Meta's numbers and the capex announcements are overdone. On the plus side, the sell-off has made Meta the cheapest among the Mag 7, despite delivering double-digit revenue and EPS growth. Minus the tax expense, EPS growth would have been in double digits. So I will most likely be adding to my existing position in Meta within the next 72 hours, because when a sell-off is driven by psychological factors and not company fundamentals, that to me is a buying opportunity. All things considered, Meta may have been an outlier, but the rest of the Mag 7 delivered, and the market that led the markets to maintain their momentum, that led the markets to close October on a 3-week high. And now we move to the Fed and the rate cut decision. So clearly the critical market driver was clearly AI-related earnings, the Mag 7 earnings. The common theme was AI. Everybody else took a backseat. But nonetheless, you cannot say that the development from the Fed and the development from the President Trump, President Xi showdown in South Korea was not relevant. It's just the fact that AI was slightly more relevant, or significantly more relevant. Slightly would be an understatement. So let's move to the other development, which is the Fed. Again, the rate cut decision. Now, unsurprisingly, the Fed cut rates by 25 basis points during its October meeting. Surprisingly, though, Fed Chair Jerome Powell signaled that further rate cuts, specifically at the December meeting, are not assured. In my opinion, I think it was the right thing for Chair Powell to say, since Fed officials are what I call flying blind and struggle to reconcile divided views regarding future policy moves because of the data blackout created by the government shutdown, which is now on course to be the longest. If it continues until Thursday, when we all wake up on Friday morning, we would have woken up to the longest government shutdown in history, okay, on record. And government shutdown is creating a data blackout. And when you have a data blackout, what it does is it results in the absence of timely reports on jobs and inflation, two key metrics that the Fed, it matters to the Fed when it comes to making their interest rate decisions. Now, the debate within the Fed focuses on inflation, which remains stubbornly above 2%, due mostly to tariffs, and to the labor market, which has slowed in monthly job gains, but hasn't shown definitive evidence of broader economic weakness. And with the number of companies announcing significant layoffs, consumer confidence is certainly weakened. The October meeting also showed that policymakers have become more cautious. Some worry about over-easing, which would reinvigorate inflation. Others fear that we are ignoring the signals of weakening demand and the labor market fragility. All things considered, unless the government shutdown comes to an end and normalcy is restored, and we have absolutely no clue when that would be, there are murmurs that talks might certainly happen after the gubernatorial races in key areas, and both Congress would come to the table, both parties come to the table. Some sort of resolution could happen. There are reports that it could not. We might not see it until Black Friday, which would definitely make it the longest government shutdown in history. All I'm saying is, unless the government shutdown comes to an end and normalcy is restored with respect to timely economic reports, your guess is as good as mine with respect to the Fed's decision in December. You would hear in the coming weeks a lot of people saying, oh, we'll get a 25 basis point, we'll have 50 basis point, but that's a could, should, would. Okay. As things stand, your guess is as good as mine. We could throw a darts board on saying, and we could still, that's all it is. Okay. Unless there is absolute complete certainty when it comes to the timeliness of economic reports, inflation and labor market in particular, don't be so sure about what the Fed is going to do in December. Okay. Finally, last but not the least, you had the President Trump and President Xi showdown in South Korea. And to be honest, the market was absolutely right in brushing it off. It basically yawned since it was highly predictable. While there were a lot of positive takeaways, the uncertainty surrounding the relationship between the two superpowers continues to exist, and not much changed post the meeting in South Korea. Having said that, the moves by the US to lower tariffs to certain Chinese goods by 10%, and the overall tariff rate on China is now 47%, in exchange for China's renewed commitment to crack down on fentanyl precursor chemicals and China's promise to ease rare earths export restrictions for 1 year and commit to buying more US soybeans, was certainly positive. Now, the easing of rare earths export restrictions is certainly a welcome relief for a lot of sectors, especially the auto companies. The question, though, remains whether China will stick to that promise or not. A lot of these promises have been made in the past only to be violated a few weeks later because somebody said something. So clearly, markets have every right to yawn and to dismiss whatever has taken place in South Korea, because we've seen this movie before. So it will depend on whether China will stick to the promise, what US officials will do, whether US officials will say something to irk the Chinese officials. Same old story, in other words. And the agreement, and moreover, the agreement is simply not expected to reverse the trend of US companies diversifying their supply chains out of China, nor does it reduce strategic rivalry, particularly in AI and rare earths. Bottom line, so many developments have taken place last week. You might actually classify them into three, but there's a lot more to that. But truth be told, markets have clearly prioritized the earnings from big tech, which tells you how much the AI trade is influencing investor decisions. The fact that on the same week you had two developments that would shake up geopolitics as well as the interest rate picture, and yet we had Nvidia hitting $5 trillion market cap and the Mag 7 dictating the direction of the market. Both of these actually tells a lot about how 2025 has firmly been the year of the AI. What was 2024 again? Oh yeah, year of the AI. Nothing's changed on that front, whether you can shake up geopolitics, you can shake up interest rate picture. AI is all that the markets care about as things stand. It would be interesting to see how November and December plays out, but to me, AI will be the number one market mover even during this period, especially November 19th when Nvidia reports. Boy, oh boy, I can't wait for that one. Best not to fight it is all I can say when it comes to markets and their love for AI. On that note, I'm going to take you to India now. The next segment, the Doctor Goes Home segment, where after a couple of months, I'm back to reporting the auto sales number and what I really think about it. So a new month means it's time to take a pause on all the market action that's taking place in India and focus firmly on the Indian auto sales numbers. And boy, has there been so much positivity, so much festive cheer, you could say. October was a fantastic month for Indian automakers as they experienced robust growth propelled by a festive season demand, resilient consumer sentiment across passenger vehicles, two-wheelers, and more importantly, electric vehicles, which were down in the doldrums in the months building up to the festive season. Let's get to the top car makers individually now. India's largest car maker, Maruti Suzuki, saw a very decent growth in its total sales, growing about 7% year over year, coming in at a little under 221,000 units. Domestic sales clocked double-digit growth, coming in at 10.5%, while the mini segment, your Altos and Espressos and so on, saw a decline in sales. The compact segment actually saw an uptick in sales. Utility vehicle SUVs continued their strong upward trajectory, sales reaching 77,571 units compared to 70,644 units during the same period last year. And that's UV sales alone. Overall, a very, very strong October for India's biggest car maker as it took full advantage of both the festive sales, festive demand, and the GST 2.0 reforms. Hyundai, second largest car maker, had also had a very strong month. It registered total sales of about 70,000 units, driven by a strong 11% year-over-year growth in exports. Its SUV models Creta and Venue posted a combined 30,119 units, their second best monthly tally, affirming Hyundai's SUV dominance. And the company also during the latest quarter saw its rural sales contribution reach an all-time high. 23.6% of the total domestic sales is what the UV sales contributed to. So fantastic. And it simply highlights that India's second largest car maker, it actually highlights its deepening footprint in smaller towns and rural clusters. The company continues to dominate the SUV space, and while it has had issues in the US, while the global and other global regions because of the tariffs, its India growth story for Hyundai firmly remains intact. My new favorite automaker, Mahindra & Mahindra, saw its PV units register a whopping 31% year-over-year growth, hitting a record monthly high of 71,624 units, reflecting sustained demand for its SUVs. M&M's best ever monthly SUV sales figure, as noted by the company's management. Exports for the automotive business also registered a very, very strong 41% year-over-year growth. The company's management highlighted that the October performance was powered by a mix of robust festival demand, positive rural economic activity, and government policy tailwinds, especially GST 2.0 reforms. The company's electric vehicle portfolio should also see an expansion very, very soon, as the auto giant is all set to unveil its new seven-seater electric SUV dubbed the XEV 9S. I have no words, no superlatives when it comes to describing Mahindra & Mahindra. All I'm going to say is this company just continues to scale new heights. Finally, moving on to Tata Motors, my other favorite automaker. Sorry, it's now a second favorite. It had a record-breaking sales in October as well, marking its highest ever monthly total sales overall, and continuing a very robust growth trajectory driven by demand for SUVs and EVs. Passenger vehicle sales actually saw a very strong 26.6% year-over-year growth, with SUVs powering this performance, accounting for a record 77% share of the total PV sales. EV sales posted a historic high, reaching 9,286 units, which represents a whopping 73% year-over-year growth, driven by strong demand for models like the Nexon EV, Tiago EV, and growing traction for Harrier.ev. With Safari EV also set to be added to the EV portfolio soon, the company's EV portfolio overall is certainly heading in the right direction. The expanding dealer network and competitive pricing also reinforced Tamo's standing as one of India's fastest growing automakers in 2025. That's it for the major PV players. Now we move on to two-wheelers like we always do. Hero MotoCorp reported strong sales momentum in October 2025, continuing its position as the world's largest two-wheeler manufacturer and capitalizing on festive demand, new product launches, and consumer-focused strategies. Hero's Vida electric line sustained growth, buoyed by new launches and a sharp increase in consumer adoption, reflected in a leap in market share for Hero's EVs. With the company having entered key European markets in recent weeks, I'm talking about France, Italy, Spain, watch out for the export figures in the coming months, which is on track to show very, very strong growth thanks to this new expansion move. TVS Motor continued its stellar growth, registering 11% year-over-year growth overall. Exports continued to surge for the company, registering a 21% year-over-year increase for October. Royal Enfield continued its upward trajectory, registering a 13% growth year-over-year. Exports, surprisingly, shockingly, registered a decline, something you don't associate with Royal Enfield, especially in recent months. They actually fell 7% year-over-year, indicating global headwinds for shipments abroad. Bajaj Auto, one of my latest investments, new investments in the auto portfolio that I hold, also had a very positive month, with exports clocking double-digit growth and domestic sales also registering a decent growth. Bottom line, when you combine PVs, two-wheelers, all of that, October 2025 marked a period of powerful recovery for India's auto sector, underscored by consumer enthusiasm, portfolio expansion in SUVs and EVs, and broad-based gains across manufacturers, a very strong indicator of sustained industry resilience heading into the final quarter of 2025. The festive season significantly boosted sales, with most automakers registering double-digit annual growth across PVs, two-wheelers, and exports. SUVs and electric vehicles were also standout drivers, with leading brands registering record sales in these categories. Going forward, the question is, can the automakers sustain this momentum? Or was it a festive season blessing? Was it a one-season wonder and that's it? Our latest report from Phillip Capital actually suggests the two-wheeler sector is poised to outperform the PV segment for the remainder of 2025, buoyed by robust festive demand, a rural rebound, and selective discounting practices within this overall space. Investors, as such, in my opinion, might want to give more focus on the two-wheelers than the four-wheelers, although if you really ask me, having held auto portfolio for a while now, if October was anything to go by, you are likely to win, no matter which sector you choose. With that, we're going to head to the final segment, Dr. Dissects, where actually it's not going to be an industrial company, it's not going to be an AI company, it's going to be a banking giant that is going to go under the microscope this week. And I'm talking about Goldman Sachs, ticker symbol GS, which actually reported its Q3 earnings a couple of weeks back. Unsurprisingly, very strong quarter, beat on both the top and bottom lines. More specifically, Q3 revenues came in at $15.2 billion, up 19.6% year-over-year, and beating analyst estimates by $933.6 million. Diluted EPS came in at $12.25, up 46% year-over-year, and beating analyst estimates by $1.60. The tangible book value per share, a very key metric for banks, now stands at 331.72, which is up 5% compared to where it was at the end of last year. The bank's annualized return on equity ROE came in at 14.2%, up 3.8% year over year. Finally, the bank returned $3.25 billion into shareholders, which comprised $2 billion in share repurchases and $1.25 billion in dividends. Goldman Sachs also announced a dividend of $4 per share, a quarterly dividend of $4 per share, in line with the previous dividend payout, and which represents, a forward yield of 2%, 2.03%. Moving on to the takeaways like we always do, Q3 was yet another phenomenal one for GS, for Goldman Sachs, when it came to deal making, as evidenced by the 60% year-over-year jump in advisory revenues and the 21% year-over-year jump in equity underwriting revenues. These were driven by significant increases in M&A volumes and IPOs, respectively. Debt underwriting revenues also saw a massive 30% year-over-year jump, driven by an increase in leverage finance activity. Goldman Sachs ended the quarter firmly as the leader in both announced and completed M&A, as well as in the second spot for high yield and leveraged loan offerings. With deal-making firing on all cylinders, it is no surprise, in my opinion, that Goldman Sachs continues to remain on top of the charts with respect to M&A, given its stellar track record. For instance, the company has advised on over $1 trillion, no, I didn't get that wrong, 1 trillion, trillion with a T, in announced M&A volumes year to date, with the next closest competitor lagging behind by $220 billion. The difference between 1 and 2, $220 billion, it's billion with a B, just shows how much leadership Goldman Sachs has. And it demonstrates how dominant Goldman Sachs has been when it comes to M&A advisory. Moreover, what should please investors is that the momentum in M&A shows absolutely no signs of slowing down anytime soon. During the earnings call, management mentioned that they see 2026 to be a very strong year for M&A, in fact, stronger than 2025, unless there is some severe macro disruption. Furthermore, the combined, which is M&A, equity and underwriting, and debt underwriting backlog, the total backlog as of end of Q3 is at the highest level in 3 years, which further demonstrates why there's most to come from the company's global banking and markets division. Now, the record backlog is not surprising to me, especially when one analyzes the deal making carried out by private equity firms. Q3, for instance, saw a surge in private equity-backed deals, which included a whopping $55 billion buyout of Electronic Arts, EA. More specifically, 5,083 deals were accounted for in this quarter alone, according to PitchBook, which brings the total number of deals year to date to 15,107, with a combined value of $1.61 trillion, trillion with a T again. These figures only lag the record set in 2021. Goldman Sachs management during the earnings call specifically mentioned the private equity factor, citing the 40% year-over-year jump in private equity sponsor activity and the $1 trillion of dry powder that these PE sponsors have. Moreover, with the interest rate environment also set to be favorable, especially after Fed Chair Jerome Powell's latest comments, especially after the Fed has undertaken an October rate cut. Yes, December is uncertain, but we are heading in the right direction at least. The odds are therefore heavily in favor of deal-making activity continuing its momentum, in my view. As such, while the going has been good so far for GS when it comes to deal-making, based on the tailwinds that continue to persist, and I'm not even talking about company-specific tailwinds, I'm talking about macro tailwinds as well, I would expect the M&A's growth story to continue for Goldman Sachs. Now, private credit has recently come under the microscope, not for the good reasons at all, thanks to the bankruptcies of First Brands Groups and Tricolor Holdings. There were a lot of analyst questions surrounding these bankruptcies during Goldman Sachs' Q3 earnings call. Now, in my opinion, while investors ought to be cautious, I do not see any long-term negative implications for Goldman Sachs from any fallout from First Brands and Tricolor bankruptcies. Firstly, Goldman Sachs management clearly mentioned that they do not have any direct exposure to either First Brands or Tricolor. Secondly, GS management also cited that they continue to see strong demand for private lending and as such have maintained a level of selectivity which should, in my view, minimize exposures to potentially fraudulent entities. Finally, the bankruptcies have not led to any decline in investor demand for private credit, and there are also moves being made by asset managers to bring private credit assets into 401k retirement, portfolios. When you factor in all these together, there is absolutely no reason, in my opinion, for investors to panic about the long-term prospects of Goldman Sachs's asset and wealth management (AWM) segment on account of Tricolor and First Brands. The division continues to remain strong, and with the bank expected to raise nearly $100 billion in alternatives by the end of the year, and with the assets under supervision setting new records with each passing quarter, the key takeaway for investors should be that the asset and wealth management (AWM) division remains resilient and also remains a very strong growth driver. Notebook ready, pen ready, that can only mean one thing: valuation. So, to predict, remember I told you one of the key metrics of banks when it comes to valuation is the tangible book value per share. That's exactly what I'm going to use for my valuation metrics. And to predict the tangible book value per share, TBVPS, okay, tangible book value per share, at the end of 2026, what I did was I deployed an optimized ridge regression machine learning model with ensemble validation. Not going to go into the technicalities of it. All I'm going to tell you is ridge regression is an appropriate method. It has a penalty term that helps to mitigate multicollinearity among input variables, and it subsequently avoids model overfitting, thereby giving you more robust results for the dependent variable, which is tangible book value per share. That's all I'm going to tell you. And I'm going to also tell you that it employs 10 features, which are also called predictive variables, ranked by how closely they were correlated with Goldman's tangible book value per share. The features included previous quarter's TBVPS, the year trend, time trend, asset to equity ratio, growth in equity, cash ratio, debt to equity, growth in debt, growth in assets, and any seasonal patterns. Model was trained on 21 quarterly observations and a time series cross-validation approach with an 80-20 train test split. So 80% of the model was the variable of the sample was used as the training sample, 20% was used as the testing sample. Model achieved a near perfect fit on training data. You had an R-square of 0.998, and although it had a higher error on the test set, this implies that the model was also responsive to scenarios where market volatility is heightened, as is the case today. I'll give you an example just to really simplify the model. While the model almost accurately predicted the TBVPS in Q4 of 2024, actual was 360.3, model predicted 360.12, near perfect. The results diverged during the latest quarter. Actual was 331.7, model predicted 379.5. However, the divergence was treated as temporary noise by the model rather than a regime change, as demonstrated by the persistent tailwinds for GS. Once the model was run, trained, tested, all of that, a scenario analysis was then conducted given the uncertain macro environment that investors find themselves in. The three scenarios are conservative, base, and optimistic. Okay, conservative, base, and optimistic. Now, conservative scenario: interest rates remain higher for longer, reduced M&A activity, elevated credit provisions. Projected the tangible book value per share predicted by the model is 361.54. Okay, what's the base case scenario? Base case scenario is normalized business cycle, steady client activity, moderate interest rates, predicted TBVPS 370.69. 370.69. Optimistic: very strong M&A IPO pipeline, credit normalization, rising trading volumes, and regulatory tailwinds. Predicted TBVPS in this scenario is 379.53. So you had conservative, base, and optimistic. Model predicted the TBVPS, tangible book value per share, for end of 2026 for all these three scenarios. The next question becomes, what probabilities do I assign conservative, what probability base, what probabilities do I assign for optimistic? To calculate the probabilities for each of the scenarios, the following assumptions were considered. Prediction errors are normally distributed, centered on the base estimate scenario. Each of the scenarios indicates a distinct region of the probability distribution. Once the model was given these metrics, once the models was given these assumptions, the three scenarios then came as follows. Conservative estimate is $9.15 below the base, which implies a standard deviation of minus 0.6 sigma standard deviations. Base estimate is the central prediction, obviously has a standard deviation of 0. Optimistic scenario is about $8.84 above the base case, which implies a standard deviation of plus 0.61 sigma. Model then uses a normal cumulative distribution function. The probabilities then come out to be, for conservative, 37.6%, for base, 24.4%, and for optimistic, 38%. So 37.6% for conservative probability, 24.4% for base, 38% for optimistic. Once you get the probabilities, you get the scenario TBBPS, multiply probability for each scenario with the subsequent with the connected tangible book value per share, all in all, and then you sum it all up. Weighted average tangible book value then becomes weighted average tangible book value per share then becomes 370.61. 370.61 weighted average tangible book value. Goldman currently trades, according to Refinitiv data, Goldman currently trades at a forward price to tangible book of 1.74. Okay, 1.74. All you got to do is multiply that, and you multiply 1.74 with 370.61. The price target comes out to be 645. The model basically says that Goldman is about 18% overvalued. The question then becomes, should I sell? Hold on a minute. Before you sell, just keep in mind that it has very strong fundamentals, as evidenced by the 9.3% annualized growth in tangible book value per share from current levels. The only problem is current valuation. Not appropriate for whom? It is not appropriate, in my opinion, for new investors to enter the name. Stock's momentum is also very good, but not fantastic. It has a short-term stock momentum grade of B+ on Seeking Alpha's momentum scale. Strong fundamentals, valuation problem, not asking to anyone for sell. All I'm saying is new investors probably need to wait for better opportunities to enter the name. And as such, all things considered, my rating on Goldman is hold. And the last time it was a buy, so I am downgrading to hold, but that doesn't mean I'm poo-pooing on the fundamentals. I'm essentially basically saying valuation is a concern. So bottom line, all I got to tell you guys is, as we wrap up the show, as we wrap up the segment, Goldman Sachs had yet another very strong quarter, beat on both the top and bottom line. Bank is fully capitalizing on leadership in M&A space, as evidenced by the strong growth seen in the global capital market segment. At the same time, the bank's asset and wealth management arm remains resilient, and the recent bankruptcies of Tricolor and First Brands are unlikely to stop that momentum. From a valuation perspective, my ridge regression machine learning model that I deployed suggests strong growth in the bank's tangible book value per share going into 2026. However, at current valuation, that remains a barrier to entry. As such, I am downgrading from a buy to a hold. My rating downgrade is purely based on current valuation, and given the tailwinds, existing investors, in my opinion, should continue to hold on to their shares. And in my view, wait for a better entry point to add further. Same goes for new investors. That's all the time I have for you this week, ladies and gentlemen. If you have a specific Indian or US stocks suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week with a brand new episode. Until then, stay safe and make some money.